Alrighty, what is going on, everybody? Welcome back to another quick CYPRX fundamental video breakdown. I'm still seeing a lot of confusion amongst manual retail investors and other large influencers on the internet space as to what's going on in the digital asset space, why crypto prices and assets all across the board are down off of their most recent pump. So in today's video breakdown, we're going to cover that in depth, again, showing you guys some insights into our private community, reading some of the fundamental breakdowns that we give to our private community members in our monthly access Discord. So that way they firmly understand what's going on with current market dynamics, what could potentially take place leading into tomorrow's US data front that could result in a potential recovery of risk assets if we see certain scenarios play out, which we're going to talk about in today's video breakdown. So if you enjoy these quick insights, giving you all perspectives into current market conditions, do us a favor, smash that thumbs up button and subscribe. So you don't want to be the type of market participant that is confused on what's going on in the digital asset space right now and risk assets as a whole. You really need to understand the assets in which you are investing in, whether it is a risk on market mood, risk off market mood, whether it's a good time to implement capital into the market, whether it's a good time to sit on your hands. So let's talk about why we've seen a recent decline in risk assets, particularly focusing our attention on this week. So in the past 2 consecutive days, the digital asset market has experienced a significant amount of selling pressure, largely attributed to a shift in the narrative surrounding interest rate cuts, which has been driven by recent data releases from major jurisdictions. It's crucial to grasp that the primary driver behind the strengthening of risk assets over the past consecutive couple of months, pretty much since late October of last year, 2023, has been due to the speculation around global central banks considering monetary policy adjustments through interest rate cuts. However, recent data releases have tempered this particular market sentiment. This week's risk-off sentiment has been primarily influenced by positive data from the US and UK front, alongside hawkish comments from Federal Reserve officials. On Monday, the US dollar index surged to around 104.900 following stronger than expected United States ISM manufacturing PMI data for March. Now, this unexpected rise in manufacturing activity reaching above the crucial 50 grade threshold for the first time in 15 months signals a robust economic recovery in the US manufacturing sector and overall positive economic outlooks on the US front. Such a surge in manufacturing activity typically diminishes the demand for risk assets for several reasons. Firstly, it suggests the strengthening of the economy, prompting investors to seek safer assets, i.e., the US dollar. Secondly, it implies a potential increase in interest rates or keeping interest rates higher for longer by the Federal Reserve to counter inflationary pressures, thereby making riskier assets less appealing. Remember, reiterating back to the beginning of this entire breakdown, what's been keeping risk assets extremely bullish over the past consecutive couple of months? The whole narrative that the Federal Reserve and other global central banks are going to start to usher in rate cuts. Now, this narrative overall contradicts the dovish sentiment that was expressed by Jerome Powell during the March FOMC meeting that we saw a couple of weeks ago, where he hinted at the possibility of 3 interest rate cuts in 2024. Furthermore, overnight, last night, during the London session, the UK also reported upbeat PMI figures, indicating signs of recovery in its manufacturing sector, just like the United States. This unexpected data contradicted the previously dovish stance of the Bank of England that was delivered over the past couple of weeks, fostering doubts about an imminent rate cut. Consequently, this narrative shift weighed on the bullish outlook, supporting risk assets and the entire cryptocurrency market. So these fundamental factors, these shifts in sentiment, are some of the key drivers as to why we're seeing strength in the Great British Pound, why we're seeing strength in the United States dollar, and why we're seeing outflows of riskier assets like cryptocurrency. Now, that is not the only thing. Moreover, today's hawkish comments from the Federal Reserve Bank of San Francisco President Mary Daly added to the dampening of the optimistic rate cut narrative that has been driving risk-on sentiment. Daly highlighted the need to assess the duration of maintaining current interest rates, i.e., higher for longer, mentioning a gradual decrease in inflation and a noticeable supply-demand disparity in the housing market. While there's a trajectory towards the adjustment of interest rates, The economy has not reached that point yet, and she made that clear in her speech today. Overall, the market sentiment is, for a fact, undergoing a shift, as initial expectations of central banks swiftly implementing rate cuts are being reevaluated. The resurgence in strength of domestic currencies like the United States dollar and the Great British pound further reinforces this sentiment shift. Additionally, safe haven assets like gold have also seen increased demand due to geopolitical tensions, as they tend to rise in value, i.e., gold, safe haven assets, during periods of fear, uncertainty, and doubt or conflict, further detracting from the appeal of digital assets, i.e., risk assets on a broader scale. Geopolitical tensions, we know, have a profound impact on financial markets, injecting uncertainty and prompting risk aversion among investors. During such times, the value of risk assets tend to decline as investors become cautious about the potential economic fallout from geopolitical events. This was prominently displayed and can be a very good example to reiterate back to via the Russian attack of Ukraine back in 2021 when Bitcoin topped out at its previous all-time high and the market started to decline, coupled with the Federal Reserve raising interest rates at a rapid pace. Now, this uncertainty overall via geopolitical tensions drives investors towards safe haven assets, particularly in this case, like gold and government bonds, leading to their increased demand and higher prices, which we've just recently seen gold hit new all time highs and continuing to remain bullish at those all time highs for the time being. So, all in all, in a nutshell, we need to keep in mind that due to the shift in sentiment surrounding the interest rate cuts, coupled with geopolitical tensions, this is creating a flight to safety and diminishing the appeal of risk assets for the time being. Now, you have to understand that if you zoom out, you guys know, and if you've been a follower of this platform for some time, I'm still extremely bullish on risk assets. Zoom out and understand that these corrections are healthy in a bull market. Understand how to adapt to them, understand how to ride the waves of the market, and understand what is creating sell pressure intraday on risk assets. So, for our focus tomorrow, our primary attention pivots towards key economic indicators: the ADP non farm employment change, the ISM services PMI, and final services PMI figures on the US data front. These metrics will be the key economic and fundamental indicators providing insights into the health of the U.S. labor market and services sector activity for tomorrow's New York session. Now, the ADP non-farm employment change indicates the monthly change in non-farm private employment. Meanwhile, the ISM Services PMI and Final Services PMI gauge the performance of the services sector, reflecting economic conditions. I know that this stuff sounds significantly boring, but it's extremely important for you all to be paying attention to. And these are some of the insights that we give via the education that we provide to our private monthly members. So that way they are actually informed on what's going on, what's creating order flow for these asset classes, inflow or outflow of risk assets, so on and so forth, so that we can properly adjust our portfolios and we can properly trade or invest on the right side of the market. Now, for risk assets, particularly crypto and equities, in focus tomorrow, a scenario where PMI figures reveal a contraction or fall below the 50 grade mark would likely be the most favorable scenario to see a recovery in the recent decline in risk assets that we've seen across the board. Such results signal economic weakness, potentially prompting investors to seek higher returns in riskier assets, thus supporting their prices. Additionally, this could further support the rate cut narrative that would most likely lead to a depreciation of the United States dollar, pulling back off of its most recent intraday highs. Conversely, we need to play the opposite and be reactive because robust ADP non farm employment change, coupled with positive PMI figures, could strengthen the United States dollar further. This scenario would most likely raise expectations of tighter monetary policy or higher interest rates for longer, leading to further selling pressure on risk assets, and so on and so forth, leading to dollar strength. Now, positive PMI figures as well could also reinforce the narrative for maintaining higher interest rates longer, which inevitably would lead to a boost in the dollar's appeal to investors and continued dollar strength. Furthermore, another thing that we need to be paying attention to is market participants. We need to closely monitor any geopolitical escalations that may drive more demand for safe haven assets like gold or the US dollar. Again, further geopolitical escalations, fear, uncertainty, and doubt would further lead to outflow of risk assets. We also have some Federal Reserve speakers scattered throughout the day tomorrow. So, hawkish comments from any Federal Reserve officials, including Jerome Powell, whom is scheduled to speak tomorrow, and any hints of a more aggressive stance on monetary policy tightening could bolster or strengthen the dollar and further weigh on risk assets. Conversely, the most ideal scenario would be for us to see dovish remarks supporting the prospect of interest rate cuts, which may lead to a potential recovery in risk assets. So, these are some of the things that we are primarily focused on here at CyPrX. And as an individual market participant, instead of feeding into all of these influencers on the internet who have no idea the vast majority of the time where prices are going, what's going on with price action, why we're seeing a decline in the current cryptocurrency market landscape as a whole. You, as an individual participant, should be focused on these things for intraday price swings, and so that way you can position yourself accordingly on the right side of the market. As always, many blessings to you guys. I hope that you all enjoyed this video breakdown. I know that this stuff is boring. At the end of the day, it's boring reading this information, but it is the information that is extremely relevant and is extremely important for you to soak up and digest so that way you can react to the current market conditions properly. If you enjoyed these insights and you're one to actually seek further education and knowledge and improve in your investing and trading career, come and join us at CyPRX. We would love to have you in our private community full of like minded individuals that are really uplifting and really looking to further their careers in this investment landscape. As always, be cognizant, be aware, this is not financial advice. Make sure that you are reactive when these news fundamentals come out intraday. In case we do see a further decline in risk assets, you all are now well aware of the scenarios in which we need to see in order to see a recovery in risk assets. The most favorable and ideal scenario for us tomorrow to see any type of recovery in risk assets would first initially for us to see a decline in the dollar, led by a de-escalation of geopolitical tensions and downbeat PMI figures from the US front and downbeat ADP non-farm employment change figures, right? Obviously, of course, play the inverse in case any of those figures come out robust or upbeat or above market forecast, driving strength back to the dollar, coupled with any hawkish comments from Federal Reserve speakers, further weighing on the rate cut narrative, or any ongoing geopolitical escalations that take place overnight. Many blessings to you guys as always. Be cognizant, be aware out there. I cannot stress enough. Don't feed into the narrative that it's okay to not know what's going on in the market. Understand what's going on in the market. This information is readily available to each and every single one of us. You just have to know the right community, or you just have to know where to find it. With that being said, I'll see you all in the next video breakdown.